Hello and welcome to this lecture. So this morning we had a bit of a challenge online, and so I couldn't really go through the questions the way I would normally love to. And so I'm doing this video as a follow-up on today's lecture. That's why I'm sending it immediately. Now, let's go through the questions. Question one we have done. And basically, the idea is for you to know the rate to use and also what to do at the year end. And more importantly, we read the standards so we can prepare financial statements. So at the end of the day, you should be able to prepare extracts from the financial statement. So in this video, I'll also show you how these figures you will calculate, the journals you pass and everything will end up in the statement of profit or loss, in the statement of financial position. And so in your own learning too, you should look to do the same. So question one, an entity whose functional currency is Ghana cedi sold goods, sales to a customer on credit, 100,000. Now, functional currency is Ghana cedi, and therefore the foreign currency is rand, 100,000 rand. And so the date of this transaction is 1st November, and the rule is to the rule is to convert this transaction using the transaction date rate, which in this case will be the 1st November 2020 rate of 1 Ghana cedi to 5.8 rand. We did that in class, and so you're going to take the 100,000 rand and you divide by 5.8, and that should be giving you an answer. Guys, by now you know that when you are doing accounting with me, you need your calculator, your notebook, your pen, your paper. Don't just watch the video. Pick paper. If there is a mistake, get back to me. But don't just listen. It doesn't work like that. So do your calculation, get your figures, and you pass the double entry. The double entry will be to debit. It is sales, so you will debit your receivable and credit sales or revenue. So that's the double entry. And then because it's a journal you are passing, there will be a narrative. Okay. Then at the end of the year, once you have not paid, once the currency, the foreign currency is still in the books, you must translate the balance. You must translate the foreign currency balance to using the closing rate. Now, your payable balance, your receivable balance is a monetary item. Is a monetary item. So you use the closing rate. You translate it. Now, when you translate it, then the difference between the rate at which you entered the first transaction and the rate at which you are now translating at the year end will become an exchange difference for you to account for. And so that goes back to the name of the standard, the effect of changes in foreign exchange rates. And so the foreign exchange, these rates, the changes in them will lead to an effect, gain or loss on the financial statements. And so that's what we are dealing with. This question one we have done in class, but let's see how it will look when you pass the journal. You debit receivables and you credit sales. And then at the year end, you translate the same 100,000 at the rate of 6.3. And that 6.3 will give you 15,873. And so that becomes the difference between what you first entered, 17, and the closing translation of 15,873. And that's what gave you the exchange loss. Now, it is loss because it is receivable, an asset. And the value of your asset at at the date of transaction is 17. Now the value of your asset at the end of the year is 15. You are losing value. Your asset has reduced in value, so it's a loss. Your asset has reduced in value, so it's a loss. So that's how you look at it. In question 2, the entity has the functional currency of Ghana cedi. So it's cedi functional currency, and then purchased goods. So that makes it purchases and payable on credit, purchases and payable from Mexico. Now take note that if the goods were not acquired on credit, it means maybe they paid cash. Then immediately they will pay the cash. So they will convert the transaction and pay the corresponding cash. And so we wouldn't have a balance at the end of the year. We have a balance at the end of the year because they may not have paid. So you need to understand why we are going to the year end and doing translation. If they've paid, we will not have any translation at the end of the year. But if they have not paid, then we will have payable. Or if they have not received the money, then we will have receivable. And those receivables, which are linked to foreign currency, must be translated at the end of the year because they are monetary items. So at inception, on day 1 transaction date, they will use the transaction date rate, which means this 129,000 purchases, they will convert into Ghana cedi at 129,000 divided by 9.6. Now we were told that as at the year end, this year end, they have not paid. So what it means is the entity still owes 129,000 at the year end, and therefore at this year end they will translate the 129,000 at the rate of 10. So this one gives 12,900 and this one gives 13 something. This is where I say take your calculator and do your calculation. This one gives you 13 something and this one gives you 12,900. And so because of the difference in the rates, we have an exchange difference. And then you need to know. Now this is payable. Payable. Here, this figure, we will debit purchases, which will go to cost of sales, and then we will credit payable, liability we owe. So if at the end of the year you translate and then your liability has reduced from 13 to 12, then you have gained. You are going to pay less for the same transaction. So it is an exchange gain. That's what makes it a gain. And once it is an exchange gain, you recognize it in as credit in profit or loss. You recognize it as credit in profit or loss, and therefore you debit payable. Again, let's see how that will look. So before I show you the second one, your receivable, if you were preparing extracts from statement of financial position, then you have the receivable that was translated at the end of the year to 15,873. And then if you were preparing extracts from the statement of profit or loss, you have revenue, which will be 17,241. That's the revenue. And then you bring in the exchange loss, and it is a debit. So you put it in bracket, or you show something that is a debit. You can write exchange loss debit, and then you put the figure there. They are extras, so we are not adding or subtracting anything. You are just putting them down. It is, but you must put them down in a way that will show that they are credit or debit. So I show it as a negative figure. Then the second one, and so at the beginning and its inception, we debit purchases and we credit payable, the supplier, with the amount. Always remember your narration. Then 31st December 2018, which is the year end, because we have not paid, we have to translate. And therefore, from the translation, we get 12,900. That 12,900 compared to the 13,000 we brought to the books will give us a difference of 679. 679. And that is a gain because our liability of 13,579 has decreased to 12 900. So we are making a gain. That gain will be credited to profit or loss and debited to payable. So we'll reduce the payable figure from 13,579 to 12,900. Right. Then the following month, which is 31st January, we paid. How much did we pay? We paid the 129,000. We paid cash at the transaction rate. What is the transaction rate? 9.7. And therefore, we will credit cash for that. Now, as you can see, we are paying more because in the books, we closed the year with 12,900. But now the exchange rate has changed, and therefore we are paying 13,299. Because we are paying 13,299, we have an exchange loss from the settlement. So that's how you work on it. For an extract from financial statement, you must know that you prepare financial statement normally at the year end. And so we are looking at the extracts at the end of the year, 31st December 2018. And therefore, when we did the translation, our payable was 12,900. And then if you were thinking about the extracts from profit or loss, that year we recognized purchases which goes into cost of sales, and then we have the exchange gain. All right, exchange gain. Now purchases goes to cost of sales. Okay, you can show it as negative or something, that right, or you put the bit there or something, anything that will show that it's a negative figure. All right, then you have your exchange gain. So that's how question 2 will look like. In question 3, you have importation of a PPE and the sale of goods. So export of goods, sale of goods. So the entity, Emil Limited, imports an item of PPE. And this is to show you what happens if the item is a non-monetary item. So this is a mixture of a non-monetary item and a monetary item. So on 1st July, they imported plant, an item of PPE for 600,000 shillings, and the rate on that date is 10 shillings to 1, and therefore it means they will debit PPE and credit payable, the supplier, who is Zank, with the amount of 600,000 divided by 10, which is 60,000. It is 60,000. So debit 60,000 to PPE and credit payable Zang Limited 60,000. So that's the first transaction. Now the second one, which is 1st November, they made part payment to the supplier for the plant, for the PPE item. They made part payment. So they paid 270. Again, the transaction date, that payment is linked to 7.2. So you exchange 270,000 at 7.2. That will be the payment they will make. But you must remember that this 270,000 is part of the 600,000, and it came into the book at 10. And therefore, you are going to compare the transaction date rate of 7.2 and the entry, the initial recognition rate of 10. And so this same 270,000 will be divided by 10 so that you can see the exchange difference. We acquired the plant for 600,000. Now we are paying part of our bill, which is 270,000, but we are paying it at a rate different from the rate at which we bought the asset. And so we'll compare so that we can account for the exchange difference. That's what I'm trying to explain now. And then on the same day, they made sales. So here you have 540 of sales at the same rate of 7.2. So we recognize receivable and credit sales. And then on 1st December, we will again recognize sales, but at the rate of 1st December, which will be 9 shillings. And so we recognize sales again credit sales and debit receivable on 1st December. Then come 31st December, it is the year end. So we do year end transactions, year end translation of balances. So you go into the account, all the foreign currency balances will be translated at the end of the year. Because we have PPE, there will be depreciation to calculate at the end of the year. Because we have receivable, there is a monetary item to be translated at the closing rate, and the closing rate is 8. So you determine the balance of the receivable, and then you translate it at the closing rate of 8, and you compare it with the initial recognition of the receivables. Okay. So here at inception, we'll debit PPE and credit payable. And this is the 600,000 at the rate of 10. So this is 600,000 divided by 10. Please, your calculator, calculate 600,000 divided by 10 is what is giving you the 60,000. Then after that, they made payment. Made payment. The payment itself was made at the rate of 7.2, and therefore we translate the 270,000 that was paid. So we have 270,000 translated at 7.2. That is the rate at which they paid, and that is what is giving you the 37,500. Don't believe me? Take your calculator and do your own calculation. And therefore, because that payment we are making, it came into the books at 10, 270,000 at 10, we compare it with the payment we have made, 270,000 at 7.2, and therefore we have an exchange loss. We were supposed to be paying 27, but we ended up paying 37. So we have an exchange loss, and therefore we debit it to profit or loss. Then the next transaction was the export. We made sales. And that sales was for how much? 540,000. And so you have 540,000 sales at the rate of 540,000 at the rate of 7.2, and that's what is giving you the 75,000. You debit receivable and credit payable. The same sales we made another sales, not the same. We made another sales on 1st December, and 1st December the sales we made 10,000 at the rate of 9. At the rate of 9. So we made another sales of 10,000 at the rate of 9 to 1 Ghana, 9 shilling to 1 Ghana. So that's what is giving us the 90,000. Now we are at the end of the year, so we'll have end of the year transactions to deal with. End of the year, we'll calculate depreciation and we'll do translation of the payables. Okay, so year end. Let's look at the year end transactions. First, we deal with depreciation. In the question, we were told that the plant that was acquired, depreciation is based on straight line method for 5 years. And take note that it was acquired 1st July, so we'll apportion the depreciation. And therefore, you are dividing 60,000 by, or what did they say, the relevant exchange rate here. You are dividing 60,000 by 5, which will give you 12,000, and then half year will be the 6,000. So this is your depreciation, is the 60,000 plan divided by 5 years, and that will give you 12, and then is half year from July to December times 1/2, is what is giving you 6,000. You debit profit or loss and credit accumulated depreciation or the PPE. And then your exchange difference of the payable. Exchange difference of the payable. Payable as in the payment for the uh, plant. The payment for the plant. Now, remember, we acquired the plant for 600,000 shillings. 600,000 shillings. And then we paid 270,000 shillings. So we are left with 330,000 shillings. And these 330,000 shillings we will now translate at the closing rate. And our closing rate is 8. Now you have 41,250. So in your statement of financial position, 41,250 will be there as your payable. But now you have to recognize that these 330, the balance of 330,000 came into the books at 10, the transaction date. And so there is an exchange gain. It is a gain, a liability that is a gain, is a loss. The liability of 330 is now 41,250. So there is 8,250 loss. Is a loss because your liability has increased. You started with 330,000 and now it is 33,000 and now it's 41,000. So it is a liability that has increased and therefore you have a loss because you credit payable and debit exchange loss to profit or loss. Then we'll do the same for receivables. Receivables in terms of the sales we made. We made sales. Remember the currency amount we made 540,000 sales. 540,000, and it came in at 7.2. And then we made another sales 810,000, which came in at 9, I think. And so if you look at it in total, our total sales in foreign currency is 1,350,000, and the cedi equivalent in the books is 165,000. Now at the year end, we will have to translate the 1,350,000 at the closing rate of 8. And that gives us 168,750. So now the transaction date entries is 165 and the closing date entry is 168. So we have a difference, and that difference leads to an exchange gain. Again, this is an asset, receivable asset, which has increased in value, and therefore we have a gain of 3,750, which is therefore recognized here. And so if you want to prepare extracts from profit or loss, you have to remember that you had revenue you brought to the books of 165,000, the revenue. And then there is the exchange loss from the payable of 18,750, because when you made the payment of 270,000, there was a loss of 10,000 here. You made a loss of 10,000 when you made this payment of 270. This is the exchange loss of 10,000, and then another loss at the date of translation, and then you have the gain and then the depreciation. So those are the figures which you will extract for statement of profit or loss. For the statement of financial position, you have a PPE at cost and less accumulated depreciation. You have a receivable which is now 168,750, and you have a payable which is 41,250. So this is how you approach the questions. Take your time, go through, pause the videos at different points, and go over them again. All the best.